Hey everyone, welcome back to Corporate Decoder. Today we're diving into a filing that might seem a bit dry at first, but it has got some juicy details about how a company is handling its debt, and let me tell you, sometimes that is where the real story is. We'll be looking at Brand Engagement Network Incorporated's latest report. Before we jump in, if you love getting the real story behind corporate moves, make sure you are subscribed. And for even more insights and to chat with us directly, join our Discord community linked in the description below. Alright, let's get straight to the heart of this filing from Brand Engagement Network Incorporated. So what is the big news here? Essentially, the company decided to clear some of its debts by effectively trading that debt for ownership in the company. Think of it like this: instead of owing money to lenders, these lenders are now becoming shareholders. They did this recently on the 20th of December 2025. And it looks like they converted a pretty significant amount of outstanding debt and other liabilities into company stock. The total amount converted was over $1.25 million. This wasn't just one big chunk either, it was spread out among several long-term investors. Let's break down who converted what. For example, Ben Capital Fund I, LLC converted about $279,000 of debt into shares. They also got something called warrants. Now, warrants are like a coupon that gives you the right, but not the obligation, to buy shares at a set price later on. In this case, they could buy shares at $2.1 each for the next 90 days. Then we have L5 LLC, which converted over $350,000 of short-term debts into shares. This was also a pretty substantial conversion. Joseph Bevash also converted debt worth around $275,000 into stock and received similar warrants. Michael Rienberger, Joseph Cohen Trust, and Scott Wheeler were also part of this debt to equity swap, each converting their respective debts into shares, and some receiving warrants as well. Now, why is this conversion important? It means the company is using this debt to reduce its financial obligations. This can be a good thing because it lowers interest payments and makes the company look financially healthier on paper, which can attract more investors. They are saying these shares and warrants were issued without a full registration process, which is allowed in certain private placement situations. This next part sort of repeats what we just discussed, but it is presented a little differently. It confirms that because of these debt conversions, the company has effectively paid off over $1.25 million in debt and liabilities. This is a direct financial move that impacts their balance sheet, removing debt and adding equity. And again, reinforcing the point made earlier, this section just reiterates that the company sold these shares and warrants without going through the usual public registration process. This is common when dealing with existing investors or private transactions. On the 22nd of December, the company put out a press release to talk about this debt conversion and the reduction in liabilities. This is what is known as Regulation FD disclosure, meaning they are making this information public to ensure fairness for all investors. They actually filed this press release as part of their report. We're not going to focus on the press release itself here, but know it is there to officially announce this news. But wait, there is more. The company also mentioned that before this, the 20th of December conversion, they had already converted another chunk of debt worth over $500,000 on the 18th of December. On top of that, they've been settling other vendor-related obligations and reducing accounts payable, amounting to substantial sums. When you add it all up for the last quarter of 2025, they've managed to reduce their outstanding liabilities by a very impressive $2,492,004. This is a serious cleanup operation for their balance sheet. And finally, we have the signatures confirming that the company's acting CEO Tyler J. Luck has signed off on this report. So what is the takeaway here? Brand Engagement Network Incorporated is actively working to clean up its financial house. They are strategically converting debt into equity, which can be a smart move to reduce financial burdens and potentially improve their standing with investors. The significant reduction in total liabilities for the quarter shows a strong push towards financial restructuring. However, we need to consider the why behind all this debt. While reducing debt is positive, the fact that they had such a large amount of debt and short-term liabilities to convert suggests they may have been facing financial pressures. The issuance of warrants, while common, also dilutes existing shareholders' ownership if exercised. We'll need to see how these newly issued shares and any exercised warrants impact the company's earnings, per S-Hare moving forward. Looking at the bigger picture, this move is about stabilizing the company and setting it up for future growth. The question is, can they leverage this cleaner financial slate to actually grow their business and operations? The risk is that if the underlying business doesn't pick up, this financial restructuring might just be a temporary fix rather than a long-term solution. Ultimately, Brand Engagement Network Incorporated is making bold moves to improve its financial health. The sheer scale of debt reduction is noteworthy. The key will be whether this improved financial position translates into real business success and sustainable growth in the coming periods. Alright, that is our breakdown of this Brand Engagement Network Incorporated filing. What is your take on these debt conversions and what do they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.